So what happened in Q1? I think almost all of us, unless we've been on a boat in the Mediterranean for the past month, sailing across the Atlantic, and some of us have, I think, would know, broadly speaking, what's happening in the global economy. So the coronavirus, which started in China, has spread across the world, and there's no vaccine at the moment. It's very infectious. It's potentially lethal, and authorities have needed to shut down their economies to isolate individuals in order not to overwhelm the healthcare system. And not all countries have done this as effectively as others, and various countries are at various stages of the lockdown. But what we do know is that for the first quarter of 2020 and the second quarter of 2020, global economic growth has fallen off a precipice, such that we haven't seen in any of our lifetimes. In fact, we need to go back to the 1920s, the Great Depression, to see a similar rapid decline in output. So it's a very difficult time for people, and the news that's going to be coming out is going to be amplifying that. Forecasters have been trying to get a grip on what it's like to shut down most of the global economy, and talking about -20, -30% quarter-on-quarter GDP growth at the moment. I think the most widely cited study we've seen about the impact is if we are in a lockdown for the next year, the global economy could contract anywhere between 20 and 25%. And countries, I think South Africa, it was an OECD study, South Africa was expected to contract somewhere between 15 and 20%. Now those numbers are clearly very, very worrying, and it's consequently highly unlikely that any country in the world will be able to implement the kind of lockdowns we currently have for a whole year. The economic cost is just too high. So what we are going to find as the pandemic starts to become under control, or the curve starts to flatten, authorities are going to be trying to restart their economy. China's ahead of all of us here. They were the first to be impacted, but we're slowly going to see economies trying to restart. And the big question here is that as we restart the economy, does the virus flare up and we need to shut down again? So as a multi-manager, we've tried to think about this, and a lot of other people have too, as there's sort of three kinds of scenarios to the global economy. We all know the current economic situation is very bad, but it's really how quickly do we recover from it? So people talk about a V-shaped recovery, which is effectively that we can successfully start bringing the global economy back from next month, or a bit later, depending on how soon we implemented it, or a U-shaped recovery, where it's a little bit more complex to restart the economy, and certain countries are more successful than others. Or the scenario that people are quite fearful of, which is the L-shaped recovery, which talks more to a Great Depression kind of scenario, where the global economy is protractedly stored for an extended period of time. I said we've got to really go back to the 1930s to get a global economy that stays stored for an extended period of time. So most of the experience we have with financial markets post-World War II was they recovered fairly rapidly from from an economic recession. So it will be a new experience to see quite a protracted recovery. So when we think about portfolios and how we should be building them, we try to think, how do we build portfolios that are resilient to any of these three scenarios materializing? In other words, while we are hopeful that we will have a V-shaped recovery, and that will be very positive for growth assets and for more cyclical companies, we need to prepare for a U-shaped recovery, where a number of countries and companies will become under quite severe strain, or even an L-shaped recovery, where pretty much only the most strongest companies will survive. So in our own portfolios, we have been making certain incremental changes to how we position the portfolios. We think foreign equities, for example, companies with bigger markets are more resilient than South African companies focused on our domestic market. So for the first time since 2010, we're actually underweight South African equities now. We're still overweight international equities. And within international equities, we are increasingly favoring managers who we think can manage money in this kind of scenario. Our partnership equity manager, Capital, was founded in the 1930s. So it actually managed assets the last time there was a Great Depression. And we think their breadth of research and investment process well suits them to surviving in this kind of environment. We also use the manager Bailey Gifford that's looking for companies which can transform the world. It's got quite a strong tech focus. That's another manager whose style we think is well suited to this environment. So we've tended to overweight those kind of strategies in our portfolios because we think in the U or the V-shaped scenario, they're more likely to do well. But having said that, as a multi-manager, we're never trying to only invest one way. So we're also mindful of a V-shaped recovery, and there we would want exposure to South African equities in particular, likely to do well if China, especially if China leads the recovery out. I think the two important points I'm wanting to make is that the economic data at the moment looks very bad. None of us would have ever seen economic data like this before. We'd really have to go back to the Great Depression to see something similar. But the important thing is the market looks forward. So the market will look through this bad data. And if the market sees a recovery coming out of it, the market's likely to respond positive due to that. And in April, we saw a little bit of that from the markets. We tended to look through the short-term noise and become more positive that the pandemic is possibly becoming under control. They also were responding to massive stimulus that authorities had implemented in the global markets to help buoy financial assets. And that's an important point to realize as an investor, that the market does look forward and that the current news is not what it's trying to price in. It's looking forward. The point that people, I think, are worrying about, because the valuations now look very attractive. So you're getting a lot of compensation for holding equities. The point is, will these equities survive? So, and that's a question that one doesn't often need to answer. In a more normal environment, a normal business cycle, listed equities, the risk of bankruptcy is quite negligible. But clearly in a U-shaped or an L-shaped recovery, certain companies won't necessarily survive. So we are quite conscious of that when we think about our managers' portfolios and the kind of companies that they own. And we are looking to find managers who we think have a universe of companies to look from, where they're able to find quite resilient companies. So that's the other important point to appreciate about the market is what kind of compensation am I getting for the price that we're paying? And here we think there's a lot of attractiveness in South African bonds, for example, where we think we're getting a lot of compensation for the risk that we're paying. So South Africa was downgraded to junk status towards the end of the quarter. In the midst of the shutdown, that maybe seemed a little irrelevant, but it still will have implications on our ability to fund and our ability to borrow money. But more importantly, we feel the downgrade has been priced in the market for a long period of time. And the fact that it's finally happened has given us an opportunity to move more into an overweight position in South African bonds. If we can hold these instruments to maturity, and that's anywhere from 5 to 30 years out, we have quite an attractive return that we can get from holding them. And that's both the nominal bonds and the inflation-linked bonds, which will offer us compensation for any kind of inflation risk. So in our portfolios, we have moved to an overweight position in South African bonds, a max overweight position on the back of the attractive valuations, and continue to overweight international equities. And as I said, we've actually moved to an underweight position in South African equities. I've received quite a lot of questions about why you underweight South African equities, because on valuation grounds, they look very attractive. And maybe the point there is we don't need to hold a lot of them to get a significant return if there's a V-shaped recovery. But in the other scenarios, we think that they will be under quite a lot of pressure. So on the margin, we have reduced slightly our allocation to South African equities because we think the upside will be sufficiently material should the markets recover, that we don't need to hold a huge amount of equities. You remember, as a multi-manager, we're not trying to be the best performing fund at any point in time. We're trying to be consistent in terms of how we perform. And that consistency is both in terms of how we perform within different kinds of scenarios and how we perform relative to the peer group. But it's a big decision for us to move to an underweight in South African equities. Over the long term, we know this is the most reliable asset class for giving us inflation-beating returns. So we're very conscious that we've decided to dial back that risk somewhat. And it's only really because South African bonds are giving us a comparable equity-like return that we've moved to this kind of positioning. We get this question quite a lot, and I'm not in the position of meeting clients, and I understand that there's their own psychology there. But sitting in South African cash it might give one some sense of relief in the short term, but in the long term, that's not usually a reliable way to beat inflation. Even in the past quarter, where South African cash was almost the only asset class that was positive, in dollars it was down 27%. So its ability to purchase assets priced in dollars actually fell dramatically over the past quarter. And the South African Reserve Bank cut interest rates 2.25% in the past 3.5 months. So the return you get from holding cash also fell. We think the SARB is more than likely to cut interest rates further, and the risk then in sitting in cash is you're going to get even less compensation. And when one compares that to the kind of returns one can get from holding South African bonds, or the potential upside in a V-shaped recovery to SA equities, or the resilience that we think we can get from investing offshore in foreign equities, we think sitting in South African cash is not necessarily the most sensible solution. We put probabilities on the L-shaped scenario, so we see it as a sort of 25% probability. So it's definitely not our base case. Interestingly, the V-shape we also see as a 25% probability. So we think the U-shaped scenario is a much more likely scenario. But the reason we do this is not to try to predict which scenario is going to happen, but to build portfolios that are resilient across all the scenarios. The challenge of positioning oneself for an extreme scenario is that if it doesn't happen, the other scenarios can take your portfolio out. So I will always be very reluctant to invest money on our clients' behalf, just in terms of one scenario, because typically we don't know the future and the future will surprise us, and therefore we need to build resilience into our portfolios. So it's very important for us to think about the resilience that we build. And that resilience isn't just if there's an L-shaped recovery, but also a V-shaped recovery. If you've built a very defensive portfolio and the world turns out better than expected, and you don't have any upside to that good news, your portfolio is also not resilient. So we spend a lot of time trying to think about how do we build resilient portfolios and robust portfolios. And clearly, for the first time in a long time, we're needing to take seriously an L-shaped recovery in terms of how we think about assets. The other part of resilience that we're spending a lot of time thinking on is in terms of climate change and the impact that will have on the economy. Now, the coronavirus has taken the short-term news, but climate change is arguably a far bigger structural shift that's happening slower, but far more profoundly. The coronavirus will pass. It's unclear what climate change will do to the economy, but it's likely to have a permanent impact. So at the end of the quarter, at the end of March, when markets were down 20-25%, I think a U-shaped recovery was probably in the price, and I've heard managers collaborate that their assets were probably pricing for a U-shaped recovery. And then in this rally we've had in April, the markets may be thinking it's more likely to be a V-shaped recovery. But clearly that's not yet in the price, but we're moving more towards the V-shaped recovery. We expect there's going to be a lot of volatility in the next 6 to 9 months around whether it's a U or V L-shaped recovery. And financial markets are going to be constantly repricing, trying to grapple with that. So that's something that we are going to need to live with through this period. And the important point is trying to look through the short term and to try to stick with the portfolio for the long term. One of our big concerns with South Africa, we've certainly done very well given the cards that we were dealt, but we came into this crisis quite exposed. The 10 years prior to the crisis are 10 wasted years. We came in very fragile. But since we've entered this crisis, we've been exemplary in terms of how we've tried to manage it. The hope is that this opportunity is used to restructure the SOEs, to restore business confidence, and that we are able to emerge far more emphatically out of this crisis in a far stronger position. And in our portfolios, the way we are exposed to that scenario is through our holdings of South African government bonds, where we've moved to a significant position in the nominal and the real bonds. And that's the good news story that we're hoping we can achieve through there. But it shouldn't surprise you to say we're also hedging our bets, and we have maintained a strong offshore allocation despite the weak rand, because we think that it's not beyond the realms of possibility that South Africa is not able to pull this off, and that we start to deteriorate. And maybe that's a question of would I put my money offshore at the current exchange rates? We implement the portfolio that's suitable to the client, and depending on the objectives of that portfolio, we'll allocate a certain amount to offshore. And that won't change if the rand's at 19 or if the rand's at 15. We'll allocate what we think is appropriate. And then any cash flows we receive in our funds, we do exactly that. It's been an extremely eventful quarter, and it continues to be an eventful second quarter. We're very much positioned for market volatility in terms of we're holding diversified portfolios. We look for managers that we think are resilient in this environment. Their business models also need to be able to survive a difficult environment. We're not fleeing just to the most safe apparent asset, because those are already priced that they're safe. But at the same time, we're very careful about the kind of cyclical risk that we put in the portfolio. And where we have made changes on the margin, we've typically reduced our cyclical exposure to a level that we think is appropriately sized. And we've increased our exposure to managers whose strategies we think are more robust. And then we've bought quite a lot of South African bonds, which we think is offering a very attractive yield if one can handle the mark-to-market volatility, and particularly if the reformist agenda in the ANC is able to take advantage of this crisis to drive through sustainable structural reform to the SOEs and the wage bill and those other things. Thank you very much.